Good day, everybody. Brian here, quantlabsnet.com. Just wanted to go over the latest craziness on this Trump tariff business and the implications it's had, a lot of the unpredictability that's come into play. We're going to talk about two um, trading HFT funds or funds, hedge funds. First one's on RENTECH, Renaissance Technologies. They did lose money. Their last batch they lost in 2020. This is an interesting article I put up on my blog here at quantlabsnet.com. In here, it goes over what happened. So they've got two other funds outside the medallion. There's the Renaissance Institutional Equities Fund and the Renaissance Institutional Diversified Alpha Fund. They lost money, and we're going to dig into why. So there's a report from Financial Times. There was a sharp drawdown in April, and part of this is a stark reminder that reminds that even more the most sophisticated algo and powerful computing infrastructure are not immune to this sudden, irrational, and deeply human-driven set of forces that roil the global markets. So we know about what happened with President there. Just applied universal tariffs, and a couple of big things happened here. So we have uncertainty and risk. We also had to reprice the risk, and it's still kind of uncertain. So with this, models, human or algorithmic, incorporate assumptions about the geopolitical and policy landscape. Sudden credible threat of significant protectionism forces an immediate repricing of risk across asset classes. Assets perceived as vulnerable to trade wars or higher inflation, like equity, especially multinational, are sold off, while assets perceived as havens, often cash or specific currencies, may see inflows. Now, it's gotten so extreme that the US dollars collapsed. Um, and you've got to also understand the implications that it has on the U.S. Treasury as well. So a lot of these algorithms are not uh, able to predict this. So what I'm doing is looking for uncorrelated futures and assets, or sorry, uncorrelated assets, both from from the options and futures market. If you've not seen my prior video, 2.5 hour video of my webinar from last night, you're missing out. If you knew about this stuff, you could see roughly where to go. I mentioned it multiple times. And what you can see in the options market, even if it's simulated, you can sort of kind of work with what's going on there. Very important to understand what asset classes or what markets you need to participate in, specifically in the options and futures, to protect yourself and to hedge against these uncertainties. The big thing you want to look for is obviously uncorrelated around equity, treasury, US dollar, and even crypto. All right, so continuing along, so we have the speed of information. We know news travels instantly and algorithmic trading systems react with microseconds. A little time for nuanced human analysis. And again, that's why I've got the reports that I'm now putting out there for both the futures and options and all the major 40 plus commodities that you can trade, among other things, because that helps you find those particular instruments that you should be putting into and getting an actual return. Initial reaction is often rapid. Model drives adjustment based on programmed responses to keyword sentiment analysis and correlations. So that's the keyword right here for most people is correlation. You want to be uncorrelated, uncorrelated. So what we saw in the last few weeks was a a risk off event, very extreme. A lot of these sell-offs were some of the worst sell-offs since the 1930s, Great Depression. And this kind of exposes as an early exposure with the U.S. Being exposed with their national debt and what can happen. I'm actually losing money holding U.S. dollar, so I am People will ask, what am I moving into? Right now, Euro is a good one. I just put up a thing on my trading view on Euro C right here from Circle in the crypto area. That's a good one to be in, where you get growth as well, and classic hedging as well. One of the most punishing structures of systematic strategies since the pandemic. This is for the historical drawdowns that Renaissance technologies endured. So they were dependent on history. That is a very bad concept now. You don't want to sit there, as I call it, chasing the return, especially in the down market. Uh, if you looked at all the performing instruments all this year, pretty well, all those returns are pretty close to getting wiped out. I mean, and over the last few days, the markets have been kind of not recovering, but just kind of flattening out. So they haven't. There's been no recovery. But if you're moving into the classic gold and maybe the euro as well, that can help temporarily to recoup those losses. But again, if there's further action taken by China, then we're back into unpredictable methodologies. So we need to move off of this dependence on history because we are moving into basically a new financial system with all the extremes on the downside. So it's just something you need to be aware of. All our traditional ways of doing it is broken down. So quantitative models are built on historical data identifying patterns, correlations, and statistical relationships that have been true in the past. Okay, so sudden, unprecedented political announcement like these black blanket tariffs, it just blows everything out. So the algos struggle to interpret or react appropriately to genuinely novel information, especially policy shocks driven by unprecedented, unpredictable human decisions. We cannot predict that. These algorithms cannot predict it because they're based upon historical means. And here's the key right here is the correlation breakdown. So all the quant strategies, particular statistical arbitrage and factor-based approaches rely on stable correlation between different assets and securities. A good one is either gold, S&P 500 itself, US dollar, treasury, the whole 9 yards, and even standard Bitcoin or crypto as a metric. So we have a macro shock. Those correlations spike or break down unexpectedly, and assumptions underpin these strategies become violated. The paired trading divergence factor premium evaporate and model generate that sell signals across the board. The cross correlation spike mentioned directly points to this phenomenon. So this is what's going on, why things are breaking down. We'll take another analysis on a bunch of other articles, so this might be a longer video. And again, to safeguard yourself, you have to follow what I put in the latest video. Let me just pull that up just so you know what I'm referring to if you are not aware. So if you go to my channel, YouTube Quant Labs, youtube.com/Quant Labs, in there, I just posted this video. And again, it's a webinar I did last night. This one right here, Master Commodity Futures and Options. So again, 2.5 hours. So that will walk you through what I'm talking about to defend yourself and use these techniques to protect yourself. And ideally go into other markets to sit on the sidelines so you're not affected by this. So you are uncorrelated, okay? Uncorrelated. So other people will follow the trend following woes. So those trend following strategies aim to capitalize on established market trends. And listen, a lot of the trends that we've had for the last 10 years are pretty well broken down now. So what do you do? So this is what I'm talking about. So if the markets were trending upwards before the announcement of the sudden downturn would trigger stop losses and generate sell signals, potentially locking in losses as the models exit positions rapidly. There's also the leverage, and believe me, man, from what I've seen with the leverage, it's pretty extreme because you have the historical patterns you use, predictable, and therefore you leverage. So quant funds employ the significant leverage to magnify small statistic edge in meaningful returns. Leverage boosts the profits in a favorable condition, dramatically amplifies the losses during those adverse and here unpredictable moves. Sharp drawdown can quickly erode the capital, especially when multiple positions move against the fund simultaneously, which it did. And as I said, I've seen so many of the assets that were performing earlier this year have been wiped out. So we're now starting over here in April 15th, 2025. So again, if it's so extreme, you will get your margin call, and then you'll be forced to deleverage. And even on trading desks, a lot of the risk management will be uh, initializing that or kicking that off. So if you're with a prime broker, yeah, you got to do your margin call and provide the leverage and financing to cover it. A lot of hedge funds would get caught up in that because they didn't predict these kind of extreme moves. So there'll be collateral will fall. Brokers demand to move cash or securities to maintain the required margin levels. And actually, in a way, if you're forced to reduce those margin levels, it might be for the better. This forces leverage funds to sell assets quickly in falling markets, also known as a margin unwind or forced de-risking. If you watch the financial news, forced selling adds further downward pressure on prices, potentially creating a vicious cycle of falling prices. And then there's more margin calls and blah, 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 blah. And funds have to liquidate whatever they can. That's sometimes why you see gold has been dropping because a lot of the funds have to sell off their gold to cover these losses and other assets. So when you see treasuries and stocks selling off at the same time and margin calls hitting desks globally, it's not a great setup for leverage quant funds. So I can't say if RENTECH is one of those. Might be, probably. But they might be diversified to cover those losses, but still doesn't help them out. And that's why they're taking on a lot of these losses that was reported in the Financial Times. Um, so again, there's this quote, when you see treasuries, oh, we'll cover that. So the REIF and the REIDA, there's a stark difference in the performance. So the REIF, sorry, IEF, -8%, and the REIDA at -2.4. 2.4 is not too bad. I mean, there are other players that have lost probably 20+%, which is pretty extreme. Underscores quantitative investing is not monolithic. Specific strategies, asset class exposure, time horizons, and risk parameters matter. So I'm not going to go into detail here, but you can tell, like I said, where the statistical arbitrage went against them if they're factor investing as well. So you can see these articles as well. Then we have the diversified alpha fund. But so this will include equities. I would not be trading equities right now. I mean, there's a couple of equities I would, but they're foreign for their own story. Um, so there's also the fixed income, currency, commodity, and volatility. VIX is up, as you can imagine, has been up to 60. Models might focus on different types of signals, macro, trends, cross-asset relative value. They're less correlated with pure equity market movements. Again, yeah, you want to right now reduce this correlation to these ones that are already mentioned here, as I already mentioned myself. Um, so they've held up better or even profited. So they've lost a smaller amount, as I said, and the asset base of 3.6 billion potentially allow for trading in slightly different and perhaps less crowded or more capacity constrained strategies. And that's one of the other advantages of being in an uncorrelated market. So you're protecting yourself against the extreme down moves with everybody selling off because it's a crowded asset to be in. Um, so again, there's all kinds of things here. So here, from the quant modeling, someone will probably call it like a quant quake or another form of it. So their April setback inevitably led to a renewed scrutiny of quantitative investing. So there's going to be critics of quantitative investing. They point to such episodes as evidence of the algos And sophistication, inability to truly understand or anticipate unprecedented events, driven by, well, human psychology, it's systematic, or sudden policy shifts, which is one of them. Okay, continuing along here, we have, gets right down here. So right here it says that quantitative investing is still valid. I mean, for, as it says here, decades, RENTECH or Renaissance has proven that the systematic data-driven approaches can generate significant consistent alpha. Remember, they've been doing that, and they're probably the number one hedge fund out there, and their fund medallion is probably their number one uh, fund out there, even though it's internal for their staff only. Um, and they've done well over many decades, or a couple of decades, I should say. So right here, it does highlight the inherent risks and limitations of these whole techniques. And it comes back to what I said here on this video, that you have to do it in a mass with this approach that I'm now using: master, community, commodity, futures, and options. It's all futures, all options available outside of equity. Okay. So coming back to this, um, we have here models can be wrong, overfitted to past data, or simply become obsolete as market structures evolve. So again, market structures, what's happened during this liberation day with all the tariffs. And again, that's the same thing where we have unforeseen exogenous events that we cannot predict. Of course, we're talking about things like pandemics, 2020 is an example, wars, and again, major policy shifts, which is these tariffs, can disrupt historical patterns and cause models to fail spectacularly. Then we get into the crowded risk. Quant strategies, more popular, successful signals can become more crowded, reducing their efficacy and increasing potential for sharp correlated up unwinds. And that's another big one, is sharp, meaning a deeper downturn. And correlated unwinds when those conditions kick in. And again, you could also have execution risk. Markets, even the best signals, can be difficult to execute profitably, and forced deleveraging can exasperate. If you've been following for the last couple of weeks what's been happening with the treasuries going up, with the bonds going up in the U.S., there's a good reason for that. A lot of people don't realize what's happened is in the auctions for the treasuries. Normally, about 15% of those that are sold off are foreign. The last round that they had, um, where everything fell really quickly and there was a 2% drop in the US dollar, only 1% of those 15% of foreign buyers in the auctions actually bought. So a lot of foreigners are not, and these are central banks, are not buying up the US debt. So it basically comes down to a credibility problem. Um, and here's the losses that this RIEF fund loss was triggered by a surprise political announcement, served as a powerful case study in the complexities and fragility of the financial modern markets. And that's definitely now, okay, with what's been going on in the last few weeks. Demonstrates how quickly and violently the markets can react to perceived shifts in policy landscape, leading to unusual cross-asset correlation. And this is the important thing. Any smart allocator in capital, any smart institutional um, trading head will want not, or should not want to be, as I said, in assets that are correlated back to, as I said, right now, Treasury, dollar, US dollar, and US stock market, and equity generally. Okay, because what happens is it becomes a significant pressure on those leveraged players. So RENTECH was one of them as well. So here they remain the undisputed leader in the quant finance world, but there is no strategy that's infallible. Quantitative models and historical data makes the inherently vulnerable to unprecedented shocks. particularly those stemming from unpredictable realm of politics. So there becomes a divergence between those two funds and highlights the importance of strategy design and diversification within a sophisticated quantitative framework. Now, I define a new framework when you watch this 2.5 hour video. Okay, this one right here. This is a new world we're entering in, and thankfully, we have something called AI and the ability to code generate, or they call it vibe coding, what the kids call it, to be able to code generate quickly in this fast changing world of finance, I guess you could call it. So here's a lesson. First of all, we got to be humble about this. A lot of traders are very arrogant about this sort of stuff, but this is a quick lesson to understand that yes, the markets can always and ultimately will humble you. They're the only judge. If you're out there trying to use third party resources like YouTube or any social media or newsletter, um, you're depending upon those people. And if they can't get it right, you'll lose money. This is why you got to follow and do more of a DIY approach, and nor can you be lazy about it. I can guarantee you when people will watch this video only maybe 5 minutes at most will be watched. That's lazy. Continue with your scrolling and continue to lose your money. I like to be known as it's not my money and nor do I care. That's what my quote would be. Okay, so again, investors, fund managers, despite the immense data analysis and algorithmic trading, market remains complex, influenced by a multitude of factors, including human behavior, political decision, and unforeseen global events. The big driver is this one right here. It's so big. All I have to do is just go into look at the US debt clock, and boy, oh boy, this thing's ticking away. And this is what's going to drive a lot of these problems. Okay. This right there is going to drive it in unpredictable ways. And we're seeing that. And again, let me repeat also the US pretty well was going to run out of money in printing from the Federal Reserve back in January. And guess what? They're now faced with the same problem in May, all because of this. You cannot just dilly dally and ignore that. You just can't. Mathematically and economically, you can't. I've gone over that before. Okay, so navigating these waters requires not only sophisticated models, but a robust risk management and awareness of the limitation of the predictive systems. Degree of caution regarding the potential unexpected to reshape the investment landscape. So it can happen in a blink of an eye. I'm down a little bit, not a lot, but when you look at the DXY as being the big one to wake you up, and you look at the DXY, the dollar index, it had a 2% loss in one day. Okay, in one day, and that's a pretty extreme move. So when you look at the 1 month, it's just declining, and just holding that as a foreigner, which is usually the safest currency to own, obviously because it's the global currency reserve currency, but it's been declining steadily quite a bit since January, and it's accelerating. It may slow down, but when you factor in, like I said, this one, the new Euro C uh, stablecoin from Circle, that's another one to look out for, and just something to be aware of. Okay, coming back to this. So basically, Quant King may have stumbled, but the lessons learned from that stumble resonate across the entire kingdom of finance. Okay, I could go on about RENTECH, but another big one that took a big hit was this one, was the Man Group as well. They are a large fund out of the UK. So let's go into them as well. So here, hold on to your hats. Forget the predictable curves of back-tested trend following models, The market is throwing a full-blown tantrum. Sophisticated algorithms, some of the biggest players are getting KO'd, knocked out. Man Group, the titan of trend following, whose flagship AHL diversified program brutally hammered, shedding 7.8% just in the first 9 days of April. So it comes back to the quick deacceleration that people have had in the last week or so. And again, year to date, 15% down. That's huge. So they're not alone. It's been widespread. Trend DTP enhanced risk composite. Eye-watering 18% year-to-date loss. Aspect Capital Diversified Trend Fund down 11%. Commodity Trading Advisor CTA Strategies reeling a 6% loss this month and a hefty 10% this year. Okay, so again, if you come back to this video I put up, you would have avoided that. If you were known to be in agriculture, livestock, you probably would be actually making money. Or certain currencies, again, one of them being the euro. All right, so coming back to this article. So we got a mix of things that are killing it. So the market finally cracked the code of trend following, which has been on the last 10 years, let's say, if you look at the S&P. All right. Further finance now, relics of bygone era in the world of unpredictable volatility. If you want to be the world's best trader, and you're making money in unpredictable, volatile markets, you're doing well, and you're not your typical getting killed with humility type of trader. So what happens to the algorithmic maelstrom? The culprit appears to be a cocktail number of factors. So of course we talked about the tariff tango, as you could call it, geopolitical jitters. Here we're talking more, let's say, Ukraine, and other wars in the Mideast. And who knows what else could drive that as well. And a lot of that could be, as I said, the national debt of the U.S., but they won't talk about it publicly in media. So there's a whiplash effect. The confluence of factors resulted in markets characterized by violent swings and sudden reversals. Equities, bonds, currencies, and commodities are no longer moving in predictable, sustained trends. That's also including Bitcoin, mind you, the digital coin that's not working out. They're whipsawing back and forth, leaving trend following models scrambling to catch up. So, what we need to figure out is what is the volatility for certain assets. Obviously, you want to be in lower volatile or less volatile assets. Again, this will reveal it. And again, I'm going to have reports on that to automate that. So, yeah, I am pitching and leading up to the pitch if you want to keep your money. So, we have a trend following 101. Okay. So, these algos are designed to identify and capitalize on established trends in various asset classes. So, if I go back over here to Yahoo, I could give you the GSPC, which is pretty well a standard metric here. If I go back all, okay, if I go back to all, let's see here, under the advanced chart here. Okay, here we go. So you can see here, this all started in October 2023, where everything just went up. Now, if I change that time frame to all, this is like it goes all the way back since 2008, since the great financial crisis. And you can see it's dropped back quite a bit. And here's your big dip in the when the virus came out as well, the global sickness, as I like to call it. So here you can see these big dips. Will it come back? We don't know. This is a different set. As I call it, it's not your standard recession. I say that because of, as I said, the national debt, because it's accelerated immensely. The other one that's an uncertainty that a lot of people are not talking about and not factoring in is AI. And the huge army of robots are ready to come into the market to replace jobs, and not just jobs, but careers. So again, we're going to start seeing a large, high unemployment rate. And that's not talked about either. So when it comes back to the modeling in the world of quant, these factors are not considered. So again, this is why you need to start following the futures and options to see what's going on and see what real smart money institutions are doing to be able to analyze that. That is why it's so critical. There are people out there that will chase return and just churn profit, make a little bit, give it back, call it and say, oh, it's a scam and blah, 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 blah. This is not the way to trade moving forward because we are now moving into a highly uncertain period of time. Now, I can also bring in the VIX as well for volatility. And just to show you in '08, right there, it went up quite a bit to 59. And look at that. And you can see here, it's kind of elevated quite a bit. Okay. So if I look at, we're going up to 55, 60. And yes, we did achieve a 60 not too long ago. If I pull up, let's say in a 1 month, we went over 50 to 52 as the peak. That's pretty extreme already. Okay. And I think those are early warnings and completely exposes what will happen under other reasons and other catalysts that will drive this. So all these traditional algorithms will not work for you. Um, so what they try to do is they try to analyze historical data, want to set their entry and exit points and manage the risk. Not saying it doesn't work. It will work, but it's broken down now. It is broken down and there's new ways to do it. Again, this video is the start. Okay. And you see here, I put up this video saying, are high frequency trading firms dying? Are they dying? So that would mean, um, you know, basically it means that they're now going from high frequency into medium frequency. Okay. Boy, it's busy around here. So here, core assumptions underpinning these strategies and trends once established tend to persist for a certain period. In this case, as I've shown you, it's over a couple of years, maybe a decade or so, or since the '08 of the financial crisis. Current market environment assumption is being brutally challenged. Okay, this will all break down, especially when you start to see the DXY fall. Okay, that's a big one because that started. Let me see here. Year to date, you can see it's really been declining since January. The 1 year peaked out here in January 2025, and look at it, it's declined. It's already broken through on the last low of September. And if we go back a 5 year, yeah, this period was great to be in. If you were losing money in this year, you could have just held on to the US dollar, which I did gladly. Actually, I made a good, what was it, the low from 89 to 112. And that's what I did. I just sat in US cash. But here we are with this currently going on. Okay. So I do believe this is a credibility problem for the US. All right. So CIO size matters. So this guy here at AVG Capital Management Quant Multi-Strategy Fund, former Man Group executive. These models are built to follow patterns over months, not weeks. The sheer size of some of these funds can also hinder their ability to pivot quickly, right? Um, so I'm not going to get into why, because part of it's the execution of large trades to adjust their positions rapidly. Pretty tough to do. So it's beyond Man Group. We've already talked about probably one of the best in the business, RENTECH. They are getting hurt as well. So this is a universal problem. Significant drawdown in the social general trend index suggests that this isn't an isolated incident. points to a potential systematic vulnerability within the trend following space. So again, you've got to do more of this than anything else if you want to stay profitable. Okay. Um, so the market dynamics have shifted towards greater unpredictability, meaning more higher volatility, short-lived trends, which they are, and core assumption of these models need a radical rethink, which is to me this right here, this video. Okay. So it's premature to declare the death of trend following. Nothing's the death. They're just saying the higher level market regime has a change has come. So historical context we can't use. Diversification within quant, yes. One of them again is currencies. It's been proven the euro's doing okay now, outperforming the dollar. We could also look at, as I said, agriculture and livestock. I guess certain commodities may do well, but you have to know about them. Crypto may uh, evolve as well. Adaption and evolution. Brilliant minds behind these algorithms are constantly working to refine and adapt their models. You might have to throw these models away. In the video, I talked about how with AI you can quickly um, develop your own pricing engine for certain strategies that you come up with when it comes to these multiple option and future strategies combined. And you can build up pricing engines specifically for particular instruments that show to be able to move up. So when you analyze the recent losses, identifying the weaknesses in the current approaches and developing new techniques to navigate evolving market landscape. This can involve incorporating new data sources. No. Yeah, actually it depends. If you're watching outside of the things you don't want to be correlated to, is probably the best way to put it. You have to implement more sophisticated risk management. Essentially, all you're doing is just putting lipstick on a pig with that kind of statement. You got to look at it from a different view, a much higher general view. So you will see trends. Everything goes in cycles, but I personally think moving in the future, those cycles will not be as long and predictable. You will get more short-lived cycles on the upside, but there'll be a lot more deeper, unpredictable moves down. So current periods of heightened volatility, unpredictable reversals may eventually give way to more sustained trends. Yeah, this is exactly what I just said. Heightened volatility, and the worst thing, these unpredictable reversals. And those are going to become, because of exogenous events like wars, uh, massive unemployment, potentially collapse of certain big assets, and tariffs. They just come out of the woodwork that you cannot predict. So the best thing is to stay out of that business. Yeah. So we'll leave it at that. All right. So if you want to follow more with what I do, all you got to do is come over to the Learn tab and put your info in. It's never sold, never released, and now that you get a free HFT ebook. On top of that, you can keep up to date with all my emails I send out. With that, pretty active there. If you are not subscribed, not liking any of the videos, YouTube will not tell you about all the videos I put out, which I'm going to ramp up more frequently now. And best thing to do is to click on that bell icon for the channel. Other than that, thanks for watching. Have yourselves a good day.